Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters, as well as the Chief Investment Officer. This month, I am joined, as always, by Brad Sanders, the Managing Director of Tectonic Advisors. We've got a wild month of October behind us, and so we've got a good update for you. This is going to be your October market update. For the month of October, the S&P 500 was down just under 1%. Global stocks were down 2.3%. And the real story, domestic bonds down 2.5% and global bonds down 3.4%. So we'll definitely go over to Brad and the Tectonic team to kind of understand what's happened in the fixed income markets. You know, it's interesting about the equity markets and particularly the S&P. It was actually up until the last day of the month. And we had sort of a run up there of earnings releases towards the end of October for a lot of different companies, but in particular, kind of a mixed bag of earnings coming out of the Mag 7. And since those indices are market cap weighted, that mixed bag actually caused a bit of a sell off towards the end of the month. You know, it was actually overall, it's still been a really strong year for the S&P and for stocks at large. But that was certainly a noticeable thing that occurred towards the end of the month. Now, we'll talk here in just a second as we record here today on Election Day about what's going on there. But Brad, I do want to come over to you on what happened in the fixed income markets that caused such a pullback there in fixed income for the month.
Yeah, really what you've seen is the yield on the 10-year treasury went from about let's just call it 2.65, 2.7% on September 30th, and it closed after Halloween at about 4.3%. So about a 0.6% move higher in a month. What's interesting about that is that can be one of two things, really. The first is the preferable one, and that means that, and it kind of lines up with what we've seen so far. The market's been going up. We've had turmoil around the elections. You've had people feel like the economy is doing bad, but we get all this economic data that's good. And so when rates move higher, when after the Fed cuts, it's basically signaling that, hey, things are really good. This thing could overheat, and you're not going to be able to cut rates anymore. And we're going to, raise borrowing across the future because things are growing so fast that's the term structure of how rates are going to go. That kind of lines up with the market action thus far this year, where you've kind of had a lot of pessimism around the economy, but you've continued to have good data. And then, the Fed cuts rates and yields go up, right? The negative side to that would be there's too much debt. Both these candidates are going to deficit spend. And so rates are going up because nobody wants to buy treasuries. And that could be kind of a recessionary sort of indicator. What I think what will happen is that the equity markets are just going to tell us which one it is. It's really hard to say that right now. We're in the middle of an election day. We're going to have to wait to get the results, hopefully tonight, but I doubt it. Probably sometime later this week. Who knows? But once we get over that hump, I think the market is going to kind of tell you which of those is. My bet is on the former. I think things are pretty good economically. I think that's why the broader markets have started to lift, even to your point, like on Halloween. Microsoft had bad results. The Nasdaq's down 2.5%. But small caps, mid caps, the broader markets outperform those numbers by quite a bit. And we've kind of seen those same kind of companies, small and mid cap companies, do really well here recently. Mid cap value was up over 10% in the third quarter. So I think the backdrop, I think the market's kind of screaming at you two things. Things are pretty good. The Fed cut by 50 bips. It's going to be harder for them to cut further based on this data. And I think as we get this election out of the way, that we'll get some confirmation one way or the other from the market here in the coming weeks.
Yeah, no, that's good feedback on what's going on in those areas. And I think that actually that 10-year also, folks, is also what's happening or what's causing mortgage rates to actually rise post-cut as well. And that's sort of a big feature of what's going on in the broader housing market. And yeah, I mean, Brad sort of reiterated there that maybe as we get through Election Day and feel maybe some relief of the pressure that's built up in the market, maybe we see some, positive results here as we head into the end of the year. But I do think for our clients and their portfolios, how we're allocating and really viewing that is continue to stay very, very broad in our allocation to equities, and keep what fixed income we need, obviously for a stabilizer in place too. But I think since we've seen rates being signaled toward that cut that we got in September, what we've seen is that broadening out in the market. So it's a really good thing for us to understand and remained, sort of diversified from that perspective. So interesting stuff is, again, Brad said, and I discussed earlier too, that today is election day. We'll be back in front of you at the end of the month with sort of a recap of what happened in the election, what happened in the markets following the election as we head in towards the end of the year as well. So thank you so much, and we'll be back in front of you in a month.